Well, we're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Stephen Engle with David Ingles.
Good morning. Let's get to your top stories today. Bonds across the region as well as currencies come under pressure as fresh Fed commentary adding to cooling expectations of rate cuts and helping boost the U.S. dollar. Ping An is a stock in focus this hour after a 9-month profit number showing a 36% jump from a year back. Now, China's insurers are set to cash in on a post-stimulus Chinese market rally. Plus, India says it's ended a 4-year border standoff with China ahead of a possible meeting of their leaders at the BRICS summit beginning today. Right, good Tuesday morning to all of you joining us across the Asia Pacific. Thank you for joining us. Do not shoot the messenger if you're a bull. As you can see on your screens right now, it's the losses in the equity markets extending really in the Asia Pacific. We're down about 1% as Taiwan, Singapore, and Malaysia come online. Certainly, we're extending the weakness which came through out of the U.S. session. The strong dollar continues to be a big story right now. We're looking at the Asia dollar index off by about 1/10 of 1%. So this repricing along the Treasury curve continuing, as you can see, bottom of your screens, bottom row to your left, 2 and 10s right now. So we're almost entirely above 4% on the entire U.S. Treasury curve. 4.2% is the 10-year yield. So that's continuing to, I guess, in many ways affect where pricing goes. Keep in mind as well, we are moving into the thick of earnings season in the U.S. So I guess it's, to some degree, given how far price has come up of late, is it time to, I guess, pause and wait for more guidance and tangible numbers coming out of the U.S.? Right, a recap of how we traded overnight on the Golden Dragon Index. So given declines on Wall Street, this pullback further we're seeing in the S&P futures. Unsurprising, we got an 0.8 of 1% drop on the Golden Dragon Index there. Now, coming into the Tuesday session, I'm looking at the early pricing along these futures. So A50 futures on the FTSE in Singapore, and the second ticker is the one here in Hong Kong, 1/3 of 1%. So unsurprising, given the downdraft in equity markets, the fix of the day should be out in about 13 minutes from now. And yeah, I mean, a lot of this, Steve, all roads lead back to the Fed.
Yeah, that's right. I mean, look, the S&P 500 probably was due for a pullback.
Yeah.
The market, many people say, is still overbought. One statistic that stood out to me, the S&P 500 hasn't suffered back-to-back days of losses in about 30 sessions. It's the longest streak since about 1928.
Oh.
It was fantastic.
We weren't around then.
What's that?
We weren't around back then.
Well, that's the year my mother was born, 1928, 96 years ago. Happy birthday, Mom.
Yeah.
Okay, so the Fed, obviously. Here's what we heard from some Fed officials earlier.
So far, I haven't seen any information that would suggest we wouldn't continue to reduce the interest rate. This is a very tight interest rate for an economy that already is on a path to 2% inflation, and I don't want to see the labor market slow further.
For me, to move quicker on the dots would be if we saw a weakening, like real evidence that the labor market is weakening quickly, then that would tell me, as one policymaker, hey, maybe we ought to bring down our interest rate more quickly than I currently expect. Right now, I forecasted some more modest cuts over the next several quarters to get to something around neutral, but it's going to depend on the data.
And Garfield Reynolds leads our MLive Asia coverage and joins us right now. Garfield, the pain is really in, well, two related parts, right? The rates market and the currency markets. I'm just looking at this statistic on the Asia dollar index. We're now down 15 in the last 17 sessions. How much more can this market further reprice Fed interest rate cuts at this point in time, though?
Well, we're actually at an interesting pivotal sort of point. When you look at the pricing for this year, where a couple of weeks ago the market was certain we were going to get not just 2 rate cuts, but that one of them would be 50 basis points. That was pretty aggressive. Now we've got about a 30% chance that there's only 1 rate cut that comes. Like, it's still the base case. You get 2 25 basis point cuts, but there's a possibility we don't get one. And more importantly, traders are being relentlessly driven to reduce their expectations over the sort of the medium term, looking through to July next year. So that's over the coming 7 Fed meetings. Again, a couple of weeks ago, we had 7 to 8 rate cuts priced in over that period. So 1 25 basis point rate cut each time with the possibility for more. Now we've got 4 fully priced in and a 5th as like a 60% chance. So it's not just this year. We've got the risk that, for example, if the Fed does cut both in November and December, that it then pauses at the beginning of next year. Now, a lot of that has to do with the data. If the data goes on being resilient, you're going to get more Fed speak about the idea that, that they're going to have to slow down their pace of rate cuts. If the data turns, as Kashkari was saying, if you get some signs of labor market weakness, well, then you will get bets on faster rate cuts. You will get a weaker dollar. You will get lower treasury yields. That might actually also be the worst case scenario for equities, because even if yields come down a little bit, equity valuations are high, and those equity valuations are harder to justify if you've got an economy that is seriously starting to crack.
Hey, Garfield, what does this mean generally then for Asian equities and also the currencies, given that really there's no one-way bet now on the Fed, nor is there a one-way bet on China's stimulus? They're kind of keeping us hanging in the balance as well. Maybe because ahead of the election, maybe because ahead of the November Fed, maybe because we're waiting for the National People's Congress Standing Committee to approve any kind of fiscal stimulus. We're kind of in a limbo state for a few weeks, right?
Yeah, I think we're in a limbo state for at least a couple of weeks, because also there's really no one-way bet for the US election, even though betting markets might be trying to signal otherwise. But for serious market players, I actually think there's a lot of signs that we are in limbo. That decline in US stocks overnight was 0.2%. The declines today in a couple of markets are not big either. There's not a strong reason to go large in either direction right now, because there are some potential positives, sitting around. China stimulus, there's often a situation where markets are tentative going into an election, and then whatever the result is, they bounce back. So, I think Asia in particular, given that election backdrop and that China backdrop, is going to struggle to go anywhere far, especially to the upside, until after the US election is done.
Well, on that positive note, it's Tuesday anyway. We have several days to turn this sentiment, the ship around. Garfield will leave it there, who leads our MLive coverage for the Asia Pacific. And, by the way, a reminder really why, if you're waking up and looking at your screens, and why it's fairly, in terms of cross-asset price action, it's risk-averse out there. The question of the day really is how far does this melt-up go on a 10-year yield? And on this very topic, do we get to 5%? When do we get to 5%? We're about 80 basis points away from that level. Send us your views, of course. Markets Live at Bloomberg.net. Right, going into the agenda today, is this going to affect trading in the CGB markets? There are a couple of briefings to tell you about today. There's a weekly briefing from John Lee, the Hong Kong chief executive, that takes place this hour. The top of the next hour, we have a briefing from SAFE, which is the Forex regulator, I guess in many ways, in China, apart from, of course, from the PBOC. In terms of earnings coming through, earnings reaction, we'll see what what comes out of Ping An, and of course the big telcos are reporting today. In terms of data points, we are in the window for both FDI and one-year lending. And as far as Hong Kong inflation goes, we'll definitely get that today, of course, based on our current schedule. Futures pointing down 0.2%. Joining us now is Xiaolin Chen, head of international at KraneShares. Good morning, Xiaolin, and thanks for joining us today. I just had a glance down at my calendar. It's October 22nd, which means it's almost been exactly a month since that major policy pivot, that briefing from the PBOC. I'm curious, net, as far as inflows into your products are concerned, how much money have you seen coming in?
Thank you for having me on your show, David. Clearly, the first phase or first stage of the rally in reaction to Chinese policies announcements of very much, we call them a game-changing policy announcements in September, that we did witness quite a massive inflow to China-related ETFs overall in the market. We have experienced quite a few billion inflows into our own ETF, probably the largest ETF in the market that has the most inflows from investors globally into China ETFs. Obviously, now we are seeing some pullbacks in the market in terms of performance, but we really sincerely think this is important steps to be materially for this market to change fundamentally in terms of looking at this China as an asset class more long term. This is actually creates some entry points for the long-term strategic investors that have missed the first quick rally happened in September. That's as an entry point for them to start to phasing in their allocations into China. But overall, I think in our firm, we believe this is staging one completed with reaction or appreciation of the decisive policy announced by the Chinese policymaker as staging one. Staging two will be fundamental, will be the implementation of the policy to be carried out in the next, if not quarters, to show investors fundamental improvement from the corporates.
Hey, Xiaolin, Steve Engle here. Obviously, you can see by your chart there, obviously, investors have pulled back a little bit after that initial rush of stimulus. And you're talking about this was a first phase, obviously, of the stimulus and then the euphoria from investors. But there's a bit of a limbo period right now. What are you waiting for next for that next driver of growth? Are you waiting for the National People's Congress Standing Committee to have some sort of move on fiscal stimulus? Or are you kind of waiting until the beginning part of the year for the National People's Congress, perhaps in March?
Great question. There will be a lot of next phases to happen. Like you said, the Congress to approve the physical spending. That's the last piece of the puzzle need to be completed. So the policy from policy stance is absolutely a check from physical, monetary, and corporate policy perspectives, all staying accommodated. Physical is, we just need to know more details on the spending side, which the next meeting will give you the closest answer possible. That's one. Second is the current phase of all the announced swap program has already been kicked off. The 500 billion is already being used by different firms in China today. And then obviously, Governor Pan announced there will be second phase if it need to be, and if it's third phase is if the market take it well. So it's really implementation of all the policy announced in September, which I have seen very quick takeoff already, and we just want to see continuation of that policy continue to be rolled out in the coming months and quarter. And third part, which is more important, is December, the Economic Forum will host in Beijing. That will give us even more colors on policy spending and overall where China's economy is standing for that front. And lastly, but the most important part is the corporates. Earnings got to pick up. You see credit start to picking up slowly, gradually. You also see the income from Chinese household also start to pick up, but slowly, gradually. We need to see more fundamental pickups from the earnings seasons to deliver their strong results in the coming quarters.
Yeah, do you think we'll get that strong set of results or at least guidance, Xiaolin Chen, this earnings season? Because markets are looking for something to latch on to while we wait for the economy to start to respond to everything that's been announced recently.
I stay very optimistic with Chinese corporates, revenue, earnings, and obviously coming season number will show themselves. But given where even they were before the announcing of the policy bazooka in September, you already see some corporates has been issuing policies of share repurchasing program. They've been looking at their own valuations and announcing, given where our earnings are, given where our cash balance is, we're going to buy our shares back. You only do that when you believe you really have a very great future of momentum or earning revenue coming into the company. You really believe your valuation is hugely undervalued. As a corporate yourself, you start to issue and buy your own shares, which a lot of companies has been doing that in China. That is before the policy announcement. Now with these programs available, add up to probably 800 billion on the first round and the second and third round to follow, you would have very sufficient, if not rich liquidity back to the corporates. And then what they can do, really expansion, focus on growing the economy. I remember the presidency a few days ago announcing like if you don't, work hard or fight now, what are you waiting for? Young ones, that's what he was saying. But I think, at this juncture, all the conditions at the moment, macro, that's one check, which is very important. All the policies is there. Liquidity is a second check factor, which is also staying very accommodative. The third factor will be, long-term for investors to switch from macro-driven of the stock performance to fundamental, that's the corporate earnings.
But Xiaolin, this special lending facility by the PBOC to allow major shareholders and corporates to buy back their shares, they need to essentially borrow from the PBOC at favorable rates. But there's no indication or there's no guarantee that they're going to necessarily have the confidence to do that. But you believe otherwise. You think that this is going to be the catalyst.
I do believe this will be a sufficient tool, at least a tool that allowing corporates in funds, in asset management, insurance companies start using them. In fact, I've been following the domestic announcements for some of the companies as a leading companies in those areas that they have already, like some of the companies, CICC, for instance, already completed their first round of leveraging that program to help the corporates. I believe there's many more to follow in domestic to leverage that program to help the corporates to have sufficient liquidity back to their company. I do think this 500 billion can be used in a very wise way, and I do think that PBOC is ready for the second round and third round as they committed. And obviously, the other 300 billion was for the the swap program with the collateral with the stocks. I do think these policies are obviously announced to give us a huge inject or increase in confidence, but most important is implementation. I am actually on the positive side surprised how quickly they roll out these programs. That from September announcement to October implementation, that was very quick turnaround. If they use this policy well, corporates start to get the confidence. Almost like a reconfirmation from top down that policy will stay very accommodative. That's a huge check. China's an emerging market. Policy matters the most. And they are giving that signal to the whole market and corporates that they stay very accommodative.
Chen Xiaolin, thank you so much for the time, and have a good time in Beijing there. Head of International KraneShares, of course, joining us out of our Beijing studios. A very brief market look. If you haven't seen it already, the sell-off is gaining traction across the Asia-Pacific. So you have everything from the Nikkei to the ASX to the Kospi index. Taiwan was off about 0.8%, all off over 1.5%, give or take. Counting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong. And the silver lining currently, and let's see if it changes, is that futures are not showing declines of this magnitude going into the opening bell this Tuesday, 13 minutes away. This is the China Show.
And welcome back to the China Show. BRICS members are gathering in the Russian city of Kazan for their first meeting since the group expanded in January. But much of the focus is on China and India as tensions over border dispute ease. Bloomberg News desk editor Jill Desis joins us now. So this BRICS meeting in Russia, is this more about really the potential dynamic between Xi and Modi, or is it more about the expanding BRICS and a unified global South voice?
Well, I think it can be about all things at once here, Steve. But ultimately, it's really that meeting between Xi and Modi that could potentially happen here that I think is what a lot of people are watching. Because, look, so Modi and Xi. So, first of all, backing up a bit, you've got the last 4 years have been obviously incredibly intense for China-India relations. We saw a border skirmish back in summer of 2020 in the Himalayas that led to multiple troops dead and really led to this kind of icing of relations between these two countries. You had India stepping in and banning a bunch of businesses from China, including TikTok, which was banned in India at that time. Now here we are 4 years on, and it does seem like we're actually getting a bit of a thaw there. So we've just, as you said, seen an easing of border tensions between these two nations, and now we're gearing up for what could potentially be the first bilateral summit in 2 years between these two leaders.
And how significant would that be?
So at that point, I mean, you're looking again at like the geopolitical relationship between these two countries that share this very long border being, very intense at a time when obviously the U.S. and its allies are really, really pushing on China, instituting all of these trade curbs, technology curbs, as we have seen. India kind of sits in this, sort of peculiar situation here where, obviously the U.S. Is leaning on its relationship with India that it finds incredibly strong, but at the same time, you would think that China and others would want to kind of pull some of that influence away. I think that's what we're seeing a bit in here with BRICS and Russia. I mean, this is really, kind of this organization that's led to kind of challenge the Western-led order of things. We'll have to see how much that actually unfolds in Russia.
Well, to get to your point there, as BRICS is expanding, 4 new members, 10 are in the waiting, 35 have expressed interest, but we're still concentrating on the West-East divide. It's being held in Russia, but we have Modi and Xi Jinping. Is there a threat, perhaps, that other members, their voice will get drowned out? There won't be a unified Global South voice if you have so many members.
Yeah, I mean, and I do think, look, you've got, 32 different world leaders that are actually attending this summit here. I mean, yeah, there's a lot of interest both from within BRICS and these existing members and then outside of it to actually join in on, this organization here. I think what you have been seeing is that some of these newer joiners, Iran, et cetera, have, said, look, maybe we don't actually want to expand too far out. You also have some non-members that are coming here joining. Turkey's Erdogan is joining. So, I mean, yeah, there's a lot of, attention over how exactly this organization unfolds.
Yeah, Jill, and I guess your point to underscore the divide, right? Right, this very week as well, I'll just end on this thought, over in New York, there are the IMF meetings and the World Bank meetings taking place. So, you do yours, we'll do us. Jill Deese is there, our Bloomberg News desk editor. In case this becomes market moving, of course, and certainly one of the big stories there is this border dispute ending, question mark, exclamation point, some stocks to watch on the Bloomberg terminal on the back of this impasse, if you will, and perhaps encouraging developments on the back of this. Right, going into the open today, Hang Seng is down about 51%. Futures are pointing slightly higher, which is a good thing given the sell-off we're seeing elsewhere across the region. The opening bell 6 minutes away. This is Bloomberg. Right, welcome back. So 4 minutes to the opening bell, just give or take here. We're looking at a mixed open, but all that being said, which is a good thing, of course, given the 1+% drop we're seeing in most other benchmarks like the Nikkei, like you're seeing, of course, in South Korea. One thing to watch, though, is something that we noticed yesterday. This is particularly onshore. Turnover actually picked up again. So it was another 2 trillion renminbi day. Onshore markets when price, of course, was moving up as well. So just keep that in mind as we look at sort of other indicators of life in this market while we wait for more catalysts. The opening bell, 3 minutes away. This is the China Show.
And welcome back. You're watching the China Show. We're counting down to the open of markets. Dave, what are we looking for?
Well, I mean, on the way to work today, randomly, while I was listening to music, you probably know this group, England Dan and John Ford Coley.
Sure. You
know the song Sad to Belong?
Not really.
Yeah. Anyway, I think it's one of the perfect soundtracks right now for portfolio managers. And, the lyrics go something like, it's sad to belong to someone else when the right one comes along. Sorry, that's a bit random and tangent here. But if you're heavy, if you're overweight on markets like India, Japan, and the US, and if China continues to rally, it is sad to belong to someone else's allocation if you need to reallocate back to China. Okay, that's a bit deep, but, we'll take any soundtrack in any shape or form we go, and it's certainly a question of, is it a zero-sum game? We were having this conversation yesterday, right?
Yeah.
With the JPMorgan asset management guest, and what do people who have been overweight in India, Japan do now that China starts to come back?
Yeah, where do you rotate? Do you rotate?
Do you rotate?
And then run the risk of getting burned by rotating when everyone else is rotating out?
Yeah, there we go. Listen to that song, kids. It's a beautiful, it's a timeless classic. Reason we're doing this is there's not a lot in markets to tell you about today. We might get some to talk about the top of the next hour with this briefing Condo China Safe. We're also getting the briefing, the weekly briefing out of John Lee in 15 minutes from now. That's a schedule there. Watch for that. The open in Hong Kong, 1/10% to the upside on our very point that nothing much happening in these markets apart from the fact that I think elsewhere, though, you are getting some steep declines across Asia Pacific. We'll get to that later because this melt up in yields is a separate story. We are starting to get bits and pieces of big earnings coming through. I think this week has really been about, well, today you have the big telcos out with earnings, but really the early stars have been some of these insurers. Given how far this market has come up so far, and really they're sitting on a lot of equity holdings, so that's really, I think, Ping An 36%. Net income. In fact, some analyst actions to tell you about on the back of these earnings. I think HSBC, Jefferies, I think, came out and I think reduced their call on Ping An. Thank you so much. 8 shares to $48. China Life, 8 shares, HSBC. But taking a step back, right? So it's almost been a month exactly since that major pivot with the press briefing out of the PBOC monetary officials. So since that point in time, insurers have actually outperformed in the 8-share market by more than double the benchmark. We put that on a chart for you. I think the benchmark's up 15%, and we're up 35% on some of these 8 shares right now. So to really get us up to speed, whether or not markets are getting this one correctly, given earnings boost, Stephen Lam, our Bloomberg Intelligence insurance analyst, is here with us. Give us your take so far on what's been reported and your expectations moving forward.
Yeah, David. So yes, I think the insurance companies are definitely delivering some good news on the back of the strong equity rebound. In fact, a couple of weeks ago, we put out a report saying that based on the sensitivity analysis that we had, if all goes well, the earnings can go about 60 to 80%, give or take, for the full year. Now, actually, a few weeks have passed. And we've noticed that some of the insurance companies already provided positive profit guidance, right, for the first 9 months. I think 4 of them reported about an average of 100% increase for the first 9 months. Now, of course, people would argue that 4Q could be quite volatile. Things can go south a little bit. But let's just say if things sort of maintain at a steady pace, our expectation for the full year is about 90% profit increase on average.
So generally speaking, for life insurers and also property and casualty, is the insurance industry that much more healthy, or is this really just investment returns? They have big portfolios, and they've come up, obviously, with the stimulus.
Yes, so if you think about it, they have about over 30 trillion yuan under investments, and about 13% of that is in equities. Okay, so they are quite sensitive. And actually, all these earnings volatility comes from partly because of the change in the accounting standards that they've adopted. It's called IFRS 9 and IFRS 17. So definitely a lot more volatility under P&L and go through the balance sheet. But what I want to remind our audience is that the underlying business for the life insurance companies are also very strong. Now, I think you can look at this as a glass half empty, a glass full. The stock market's not doing great, property market not doing great. So where did the money go? A lot of them went to the deposits. And actually, a lot of them went to the life insurance products, too. So their new business value growth is actually very, very strong this year. In fact, we have a focus idea out early this year calling for a 10% beat in terms of their new business value.
Would this also apply to other players like AIA and Prudential?
Absolutely. So the AIAs and the Prudentials of the world, now, of course, they're pan-Asia, so they will get the boost from the mainland China business. But, of course, in the Hong Kong business is also doing quite well, as you're quite aware of, since the reopening. So not only that, actually, the Southeast Asia business is also getting a pretty good boost. Not as dramatic as the Hong Kong China business, but, you're talking about high single digits, low teens in terms of new business value growth.
Stephen, thanks so much. Stephen Lam, Bloomberg Intelligence insurance analyst. Stephen Lam joining us there. Well, it's been almost a month since China signaled its intent for supercharged stimulus. Of course, we've been talking about it every day. Many investors have been disappointed, though, by a lack of concrete details. Bloomberg Opinion columnist Shuli Ren joins us now. So, Shuli, we met in the hallway just a few minutes ago before the show. He said, when's the big number going to come? Should we be focusing on this big number, this fiscal number? And how close are we to getting one? Does it matter?
I think we should not doubt that the supercharged stimulus is coming, but the actual number itself is not going to come anytime soon because it seems like this round of stimulus is about debt restructuring, and it's very different from 2008 when China just said, okay, let's give some money to infrastructure building and then give jobs to migrant workers. This time with debt restructuring, before you come up with a stimulus number, you need to know how much debt there is in the first place, right? So that means that we all know China's local governments have a lot of hidden debt.
They're off-balance sheet hidden numbers, right?
Yes, and by some estimates, the hidden numbers are bigger than local on-balance sheet number and the central government combined. So we don't know how much debt there is in the first place. We need to have a rough audit. And another thing is China is going to recapitalize the big banks, but we don't know how many corporate loans could go bad as well. So we also need to do some kind of checkup. That's why I think it's hard for China to come up with an exact stimulus number right now.
Yeah, and the question, I guess, for investors is, while they've been waiting for a catalyst to take advantage of the valuation gap with the U.S., and I think it's interesting timing there. And I think Goldman Sachs came out with a note, I think it was just this morning, or just overnight, talking about how the S&P 500, that decade of above-average gains is over. I think this is the summary on our screens. And possibly, if we're looking at equity gains in the U.S. slowing, how should global investors now be thinking about China at this point in time, in the absence of a big number?
I think global investors have to be very patient. You cannot just ride on the momentum and say, okay, we are just going to get another 15% or whatever, because right now the market is already baking in the 10 trillion yuan stimulus number, right? So and then the actual number is going to come way later. And they have to take the mindset of value investing or even distressed investing. And they cannot take the mindset of chasing after the big tech, the Magnificent Seven.
One of the commentaries I've heard, while we wait for this number, right, is that possibly the big number is a fluid concept. Chinese officials will respond if and when necessary, depending on how the economy responds to this as well. Do you think that's a good thing? That, the fact that we don't have a number yet is because, to your point, we don't know what the number should be?
I think at this point, the government needs to show their credibility to actually deliver the number. And by all estimates, 10 trillion yuan should be a fairly conservative estimate, because in 2008, they had 4 trillion yuan, and China's economy was much, much smaller. And back then, 4 trillion yuan was over 10% of the GDP. So easily, we are talking about 10 to 15 trillion. But the number is not going to come anytime soon. I just think that they have to do an audit. And it's a responsible thing to do as well. Like if they just say, okay, let's churn out 10 trillion yuan and develop the Great West, and people will say no, the return on investment is going to be so low.
Yeah. Right. I mean, this is no longer the same economy that it was 15 years ago that responds in the same way to a big number. Shuli, thank you so much. Fantastic piece there. Out of Shuli Ren. Check it out on your Bloomberg terminal. Just some breaking news right now. Okay, so we have Central Hui Jin, that's one of the sovereign wealth funds, selling a record here. So let me just get that straight here. Okay, Central Hui Jin pricing a 3- and 5-year yuan bond, $29 billion. That's a record. And we now understand what the pricing is. So it's fresh issuance of, you have 9 billion 3-year debts and 15 billion as far as 5-year bonds are concerned. This is based on people familiar with what is going on. So the firm has, ETF market, okay, priced 2 local bonds, its latest debt issuance, which is quite timely as well. We get this breaking news because at the top of the next hour, Goldman Sachs, actually the head of Asia credit strategy, will be joining us to talk us through really what all this stimulus means for, number one, the risk profile of this economy, some of the corporates as well, and what it also means for demand and supply of credit as hopefully the economy starts to respond to all this stimulus. Steve.
Yeah, that's right. I was just looking about what are the proceeds going to be used for this bond. Basically, the most recent bond sale proceeds will be used to optimize its debt structure. That's Huijin's own debt structure, replenish working capital, or for other purposes approved by regulators. So not a lot of transparency as far as what the proceeds are going to be used for. Coming up next, we take you to Singapore's International Energy Week to talk about the sustainability of the global transition with the International Renewable Energy Agency Director General. This is Bloomberg. That's the man on the screen right there.
Okay, we're looking at declines here across some of the most active contracts, and the reason you have a 2% pop, of course. The other big story was over in Europe, where you had nat gas futures pushing up about 2%. That's a separate story, of course, to what's going on in the Middle East, and of course, we're still bracing for the developments there as it pertains to Israel and Iran. Some weakness still coming through in the energy markets right now. Bloomberg Commodity Index, bottom of your screens, 0.5% to the upside. Right now, speaking of energy prices, and this is a separate story that's also taking place. You can read about it on the terminal. The IEA forecasting a world of, well, hopefully they're right because things have been expensive year after year. Lower energy prices or cheaper energy as a shift towards electricity leaves behind some of the excess capacity as it pertains to oil and gas. But this is, of course, a very long-term projection, as you can see by the data we have right now. But hopefully, of course, the direction of travel is clear and accurate.
Is it, though? That's the big question.
Oh, yeah.
Right. Let's continue our coverage of the Singapore International Energy Week, the annual gathering of industry professionals and policymakers. Joining us now is Francesco La Camera, Director General of the International Renewable Energy Agency. Thank you so much for joining us. So where are we from your perspective on that transition and to get to net zero, I guess, by 2050 or even sooner as electrification in the automobile sector takes off, especially in places like China? But you're also seeing a big uptake in places like Southeast Asia of natural gas and calls for more investment in upstream facilities. I mean, do these two opposing forces contradict each other, or are we on a one-way path towards more electrification and a cleaner energy grid globally?
So just to be clear, the direction of travel is there. We are moving to a new energy system that will be largely dominated by renewables, complemented by hydrogen, mainly green hydrogen, and the sustainable use of biomass. So this will happen, is happening, and nothing will stop it. The question is not the direction of travel, but the speed and the scale of our pathway. So, because we are not only building a new energy system per se, but also as an instrument to fight climate change. So, when the direction of travel is there, the speed and the scale of this transformation is not there. We have just presented in the pre-COP in Baku last week our tracking report. It's very clear that also we are establishing new record of renewable installed capacity every year. We are not in track to keep the rise of temperature by 1.5 Celsius at the end of the century.
Yeah, you talk about the progress being impeded by structural barriers, and I think one of the things that you mentioned as well, Francesco, is that our objectives, our 2030 objectives, risks falling short of those targets. What, if you could be more specific, what structural barriers do you think we need to get rid of here?
That's we have to think strategically and structurally. So our analysis is focusing on why renewables that are today the most competitive way to produce electricity, that are clean, that are the best tool for energy security because of the decentralization, so having many actors in the market are not going faster. In our point of view, the first structural barrier that we have to overcome is the infrastructure. And also these days in Singapore, I think all have convened to say how important is the provide for a grid system that is interconnected, that is flexible, that is balanced. We all talk about the importance of the infrastructure like port, harbor. So we still have an infrastructure system that is serving a centralized energy system based on fossil fuel. We are moving to the new one, but we are moving fast enough. The second is the market. The market is still designed for fossil fuels. We provide subsidies for fossil fuels, and also we fix the price on the basis of marginal cost. No, we have to work on long-term contract. So we have to work for design a market that is more favorable for renewables that have a very highly cost upfront and then very, very low cost in the maintenance. And also the professionals. They are not ready to work, or at least they are not enough to fit with the new energy system. And also the workers. We need to reskill or skill the workers for make them fitting, be consistent with building of a new system that is coming. So these are, in our point of view, the three structural barriers that has to be overcome if you want really to accelerate our path.
I believe you mentioned COP29 in Baku. Really, what can be the springboard from that as far as a real tangible takeaway that will propel, reaching the goals that have been set by the IEA?
You know that Baku is very important. Someone thinks that will be a transitional kind of COP, but it's not true. First of all, because there they have to recommit a financial support from developed to developed country. So the new 100 billion has to be decided there. But it's the last opportunity that we have to raise our ambition. We have said in our report very clearly that the COP29 and the COP30 will be the last two COPs where we can organize the work having in mind as goal to keep the 1.5 alive. If we don't change dramatically our course, this will be the last COP. Then we have to accept the reality that the 1.5 is gone. So be the next year, the year where member state has to provide the new commitment for raising the ambition, so the new indices. This COP is very important for providing the right guidance to the member states.
Yeah, Francesco, I want to bring in the China element here because arguably it's worked too well, the model in China where you have, to Steve's earlier point, the electrification of the auto industry and, the concentration of EVs, for example, in that specific market. And right now, you look almost everywhere you look, solar, wind, lithium, it's a separate story. We're looking at problems across margins and profits for many of the big companies in China. And I'm wondering whether what's happening there is having an impact on the progress, or do you think China still has the most ideal model to follow as it pertains to this?
On this, we can just look at the numbers. Until August, I think they are in line for having something between the 10 and 20% or more highly installed capacity in China. So we are moving for something like 330, 300 something. So this inevitably means that the capacity is growing at a good pace. Naturally, it's not the pace that we need for tripling renewable installed capacity, but the market in China is on the rise, as has been in the last years, inevitably. And I made always after the year a very easy calculation. If you say how much gigawatt has been installed in China and you multiply by 2, and then you multiply by 1.6, you have a forecast of what could be the installed capacity in the world this year.
Okay, well, let's leave it with that simple calculation. Looks very simple if you think about it that way. Francesco, thank you so much for the time. Francesco, like camera there, we don't need Excel for that one. Director General at the International Renewable Energy Agency. If you're a Bloomberg subscriber, you can catch up on that specific interview You may have missed that, plus some of the others, of course, that took place here across the last couple of hours of program. And check it out for Bloomberg clients. TV Go on your terminals. Plenty more ahead. This is the China Show.
And welcome back to the China Show. Some corporate stories we're tracking today. Europe's biggest software company, SAP, has reported a jump in third quarter cloud sales as it works to move customers to its AI tools and analytics. Cloud revenue rose to nearly $5 billion, marking a 25% increase from a year earlier. Its cloud backlog rose to over $16 billion, reflecting sales to be booked over the next 12 months. Well, Qualcomm has unveiled a more powerful processor that's designed to bring laptop-level capabilities to smartphones. The shift in design is expected to help mobile devices take advantage of new AI tools. Qualcomm says the new chip will be 45% faster than the previous model. And speaking of chips, which we do often, we have a big guest coming up today, the ASML president and CEO, the man you see on your screen here. He speaks at the Bloomberg Tech event in London. Catch our coverage live here on Bloomberg TV or on Bloomberg.com. David?
Right. Just back to markets here, and the other story we're tracking, we were talking about this earlier, is this BRICS meeting, this BRICS summit, and this potential meeting, and potentially the first meeting between Indian Prime Minister and Chinese President coming through as well. And we have a couple of stocks we're tracking on the back of that border impasse, or the ending of the border impasse between the two. Watch it closely. Energy stocks on your screens for a separate story there as well. Plenty more ahead. This is Bloomberg.
And welcome back. You're watching Hour 2 of the China Show. Here's a look at the CSI 300 a half hour into the session. As you can see, it opened up lower, but is now turning positive by about 0.4%. There's the Shanghai Shenzhen Composite, the 300, CSI 300. So looking, despite Wall Street's declines, Dave, it's looking like at least China is going up while the rest of the region is taking a bit of a breather like Wall Street did.
Yeah, I was looking at turnover, and I think this chart is about to come up on your screen. So I think on Monday we had another, so on Friday we had a 2 trillion day, on Monday we had another 2 trillion day, and right now as I speak, turnover about 30 minutes into, barely 30 minutes into the session, we're now at 610 billion. So we'll, and you know what, a little bit more, we're actually already at your year-to-date daily average. So this is a story that keeps giving. We talked about insurers earlier on as a main, really main catalyst coming through from the markets. The other big group of stocks we're tracking today are these EV stocks on your screen, so really moving against the grain. JPMorgan placing XPeng on positive catalyst watch. You did see, by the way, overnight, a fairly decent move as well across some of these names as well. So hence perhaps where we're tracking a follow-on move here in the Asia-Pacific. Across the region, though, it's generally a day of losses. You had really big losses in Europe, followed by the pullback on Wall Street, and some of the big tech-exposed and tech-heavy and cyclical exposed, I should know because Australia's in this story as well, are seeing some declines. So Japan's off 1.5%, Kospi's off by about 1%. The ASX 200, 1.3%. Taiwan, which is coming off its lows of the day, 0.5% to the downside. Now, separately, of course, and arguably the bigger story, apart from the equity markets, is this bond bleed we're continuing to see in the region. So yields in Australia and Japan, as you can see on your screens, are up. We're seeing yields in the U.S. pull back a little bit, but make no doubt, of course, the big move that we had overnight, 10 basis points almost just about across the curve. And right now, it's the 5 and I believe only the 7-year, I'll correct myself if I'm wrong, are the only tenors that are below 4%. So 2 all the way to 30-year, as you can see on your screens, now have a 4 handle to this. And this is down, of course, to where maybe the Fed doesn't go. They might not do 50.
Well, yeah, that's why, the S&P 500 overnight pulled back after, a real nice run, 6 weeks of weekly gains for the S&P.
Longest one, I think, of the year.
Yeah, so there was a big chunk of gains, but there's a bit of fears of a, overbought market, obviously, in the United States. Will it have 2 days in a row? It hasn't had that in a long time. So in 30 sessions, in fact, they haven't had 2 sessions of pullbacks of losses on the S&P 500 in 30 sessions. But again, a lot of that was due to cooling expectations of Fed cuts. This is what we heard from various Fed officials.
So far, I haven't seen any information that would suggest we wouldn't continue to reduce the interest rate. This is a very tight interest rate for an economy that already is on a path to 2% inflation, and I don't want to see the labor market slow further.
For me, to move quicker on the dots would be if we saw a weakening, like real evidence that the labor market is weakening quickly, then that would tell me, as one policymaker, hey, maybe we ought to bring down our interest rate more quickly than I currently expect. Right now, I forecasted some more modest cuts over the next several quarters to get to something around neutral, but it's going to depend on the data.
Mark Cranfield, out of our MLive team, joins us right now from Singapore. Mark, what's going on exactly here in the bond markets?
People are worried about this $100 trillion fiscal time bomb that Bloomberg was writing about this week. It's coming together because it's the week of the IMF meetings, and officials from there are going to be reminding all the central bankers who are present is that their governments are all overspending and they've got no plan to rein in their deficits, and that's what's really spooking the bond markets. And of course, when you look at the US in particular, you've got the US election coming up, and neither candidate is really putting on the table anything which suggests that there's going to be a lot of fiscal prudence coming anytime soon. So it's all kind of coalescing together just ahead of the vote, and people suddenly are spooked that bond markets are a dangerous place. But also, if you look at financial conditions, they're clearly loosening in the United States as well, which isn't going to justify the kind of rate cuts which are priced in to the US curve at the moment. So you've got Fed speakers, as well as you mentioned there earlier, they're pulling back slightly, and there's certainly a chance that we are going to get a pause before too long, maybe in December or early in the first quarter of next year. This is not going to be a one-way bet where the Fed cuts rates all the way. Definitely not it's very hard to see how they can get anywhere close to the path of rate cuts, which is priced into the curves. And we may even get to a situation where we stop way ahead of that, because the Fed already sees that inflation is too sticky, is starting to turn back the other way. The fiscal deficits are out of control, and they really have to put their finger down and say, okay, let's hold back for a while and see where this is all going.
Yeah, Mark, I mean, I asked the same question of Garfield Reynolds last hour, and that is it kind of leaves investors out in this part of the world in a bit of limbo if it's not necessarily a one-way bet for the Fed, as we just heard from Mary Daly and Neil Kashkari, and we've heard, Raphael Bostic also saying, more caution is necessary. So is that one-way bet sort of maybe turning the other way, that it's going to be not as, dovish coming from the Fed?
I mean, Asian central banks didn't raise interest rates as far as the US did and some of the other G10. So in that point of view, they've got a bit of a cushion. They were a little bit slower there. We've had one or two already lowered interest rates, but not by very much. So from that point of view, Asia is not in such an exposed position. They won't like the fact that if the US dollar stays very strong, it will probably hurt emerging market currencies more. Particularly look at the Mexican peso already, but that's partly politically related to the United States. But certainly EM currencies, we can see the Korean won has weakened up quite a bit in the last few days as well. So there is that impact which will play into Asian markets and will make the central banks think twice about lowering rates again, although they hadn't committed to any great extent, so that's not so much of a problem. And China is lowering rates is the exception here. They've probably still got more to do in that respect, although one of the risks to Asia is that all of the equity inflows get sucked into China. They go away from other places because China is so underinvested. People just decide that's the best opportunity for the months ahead, and we'll just put everything back into there. And it's a very big market. It can absorb huge amounts of money. So the risks are building for the rest of Asia, but certainly the interest rate factor is not as important for them, but the currency one is a headwind. If Asian currencies continue to weaken because of a relatively strong dollar, that could be a problem for Asia.
And Mark, if I'm looking to buy this dip today in equity markets. What's your sense of how much further this pullback can last in equity markets?
I think people will be driven by what happens in the United States. Stephen was just talking about S&P 500 hasn't had two back-to-back losing days for quite a while. It's certainly due for it. So people will probably be taking their cue from that. At the moment, US futures are a little bit softer. It suggests a down opening in United States cash markets, not by a great deal. But certainly if we get another soft day in US markets, that will spook the rest of the world, particularly here in Asia. So people will probably be looking for reassurance that this amazing rally we've seen in the US markets isn't over and that it's going to go on through the US election. If they feel confident about that, then they'll probably be looking to get into some of the slightly undervalued Asian markets, particular ones that still have a good AI story. Clearly, from some of the results we've seen recently, look at TSMC, for example, clearly the AI demand is still very, very strong. So anybody that has that narrative is going to do fairly well out of this.
All right, Bloomberg MLive strategist Mark Cranfield, earlier you mentioned about the risk of those Asian currencies weakening as the strong dollar. Japanese yen right now, 150.7, Dave. Still ahead on the China show, we talk China credit strategy with Goldman Sachs, who sees a policy put already reflected in debt markets. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Right, welcome back. If you're joining us just across the world, thank you for taking the time. Just to recap some breaking news, our Bloomberg scoop about, I would say 20, 25 minutes back here, the China Wealth Fund. So we're talking specifically about Central Huijin. That's a unit, of course, that the Wealth Fund has sold. And we're looking at, so 9 billion in 3-year debt and 15 billion, this is renminbi, in 5-year bonds. That's according to people familiar with what's going on. So pricing along those lines. And it takes us really into the broader stimulus conversation, I think. Our guys at Bloomberg Intelligence had put out this note here on how this might actually, everything that's been announced in the last month might actually spur demand for credit.
It's interesting because Central Huijin Investment now has sold 207 billion yuan, $29 billion of notes this year. That's the most since it first tapped the onshore credit markets in 2010. So obviously there's moves afoot. Essentially, this fresh issuance includes a 9 billion yuan of 3-year debt securities and 15 billion yuan of 5-year bonds. This, according to people familiar with the situation, telling Bloomberg News.
Yeah. Well, you look at this, of course, and the take from Francis Chen and Nicholas Ng out of Bloomberg Intelligence. The next chart that comes up on your screens, I think we did just get the credit numbers for September a couple of days back. We've dissected that and just had a look specifically at net new issuance of corporate bonds that I believe is still negative. Also taking place right now, and we'll get you more updates on this, is this briefing out of China Safe. I'm looking right now at this briefing. It's in Mandarin, so I'm not going to do a live translation for you guys as well. We'll leave this to the AI guys. But what does this mean really for Asia credit strategy? So we've been talking at length really about equity markets, but what about the fixed income space? Kenneth Ho out of Goldman Sachs, he's head of Asia credit strategy, joins us here in set. It's nice to see you, Kenneth. So how has this changed your world?
So it's changed, I think, quite meaningfully in the sense that a lot of client conversations are now about China, whereas for much of this year it's been non-China. So the focus has really shifted back towards China. But our view is that actually, we've seen this policy put in terms of ensuring better China growth. Right. And we think actually to a large extent that's already reflected in the credit markets. Because if you look at some of the areas that people have been concerned about in the last few years, for example, the asset management companies or these LGFVs, their spreads have actually rallied quite meaningfully.
That's right.
And so we think, yes, it has been an uptake in terms of China discussions, but our core view is that actually for much of this policy on China is already largely reflected in the credit market.
So then what are you looking for next from policies, since we are all looking for top-down policy moves?
Yeah. I mean, for us, the biggest thing, and we've been talking about this for a couple of years, is are they going to do something a little bit more on the fiscal side from the central government to try and destock the property sector? Because that, for us, is probably the biggest thing that they could do to support the real estate market. According to our equity analysts, at the end of last year, they estimate that in terms of inventory in the real estate market is somewhere around 30 trillion RMB. So that's quite a big number. And then if you look at the latest numbers, it's still well over 2 years in terms of inventory. So we think that's something that we're looking for to see if they would do something a little bit bigger.
Ed, I guess you've alluded to this. We've already seen some numbers being floated around how, you know, the debt capacity of local governments gets freed up for them to then start either refurbishing some of the property or some of buying the unused property. So I'm guessing you haven't heard enough to make that conclusion just yet as far as that specific pain point is concerned.
Yeah, so we see what most of the efforts are concentrating on is on making sure completion takes place.
Okay.
Right, so
we've known that anyway.
And we've known that, and they've increased that, obviously, recently with some of the policies. And obviously, they are making moves to try and clean up the inventory. But we think you need something probably quite a bit bigger. You probably need a bit more central government support for that. And that's really kind of, I think, the biggest.
And you mentioned the LGFEs. It's a tough ask to have the provinces come up with this kind of funding as well because of the off-balance sheet liabilities, the hidden debt. Shuli Ren, our Bloomberg columnist, talked about that the sheer size that we suspect is at the provincial level and the LGFE's off-balance sheet. That makes it a severe challenge for that fiscal number to come up with the right number.
So we see the LGFE debt issue as policymakers going into a containment mode, right? So contain the issue, work it out over the long term. And if you look at government debt, so that's central government, local government debt plus LGFEs. A decade ago, LGFEs accounted for almost 70% of government indebtedness. Yeah. That has now dipped to below 50. So they are reducing the reliance on local government debt, but it's something that is going to take many years to resolve. And the way we see them resolving is they have a multitude of tools. So they have a lot of tools in the toolbox, and they would kind of reach out with various tools at various times to resolve it. For example, rolling over the debt, or perhaps getting central government or local government support. There's some restructuring that we've kind of seen earlier this year. So they have a multitude of tools that we think they would use to gradually work through this LGFE debt issue.
So what's the overall advice to clients right now, given that spreads are tight? You know, are we right to wait for a ratings upgrade cycle that may or may not come? Do I look at high yield, where some of the big banks, of course, and some of the more popular issues within high yield? So what's the overall advice?
So what we've been saying, actually, for much of this year is credit is actually not about credit. And what we mean by that is we've had credit events in the last few years, but that hasn't really derailed what's happening in the credit markets. What's really been the biggest driver of the credit market has been the global macro backdrop. So our view continues to be that, based on what our US economists are saying, quite a low risk of recession in the US, 15%. They're expecting disinflation, so US core inflation to hit 2% by the end of next year. And obviously, the Fed will continue to cut until 3.25%, 3.5% middle of next year. Yes. Those, we think, are the key supportive factors. So that should keep spreads tighter for longer. So our view is a moderate overweight on high yield over IG, and also we like some of the subordinated bank capital within investment grade as well.
Okay. Elsewhere in the region, anything top of mind for you as you look ahead to the rest of the year?
So there's been a bit of news last week on these non-bank financial companies in India. Some of them have had the operations suspended, and we see those as regulator trying to firm up regulation or the scrutiny on the NBFC sector. Okay. And we've seen similar action being taken in the last few years in the NBFC space. But we don't think this is symptomatic of broader, bigger systemic issues. It's just regulatory scrutiny. And our view on that is we actually like the India renewable sector more than the NBFC sector, because the renewable sector is one that we think has a lot of regulatory support, whereas the NBFC is one that has a lot of regulatory scrutiny.
Kenneth Ho, thanks so much for joining us here in the Hong Kong studio. Kenneth Ho, head of Asia Credit Strategy at Goldman Sachs. Now, China's State Administration of Foreign Exchange is currently holding a press conference in Beijing. Li Hongyan, China's Deputy Administrator of Foreign Exchange, holding that briefing, and as well as others up on the dais. Basically, a briefing on the country's balance of international payments in the first 3 quarters. Still awaiting some significant headlines coming out of that press briefing, as you can see on your screen right now. Plenty more ahead. Hopefully, some lines out of the State Administration of Foreign Exchange briefing going on in Beijing. This is Bloomberg. Welcome back to the China Show on Bloomberg. U.S. officials are in the Middle East in an attempt to engineer a ceasefire between Israel and Iran-backed Hezbollah and Hamas. Bloomberg's news desk editor Jill Desis rejoins us now. So obviously it's a tall task to get a ceasefire. I mean, at a time when Israel state media is talking about a reprisal attack on Iran for that drone attack, days ago around the home of Benjamin Netanyahu. What would be considered positive steps here for the U.S. team there?
Well, I think that at this point, Steve, look, this is Antony Blinken's 11th trip to the Middle East since this all really broke out a year ago on October 7th. And obviously, as of so far, we really haven't seen a ton of success on the U.S. side to steer Israel away from further action. We've obviously seen some tensions unfold elsewhere. And as you mentioned, we're still all kind of waiting for whatever this big retaliatory strike Israel is eventually going to, has said it's making against Iran. So there's a lot happening here. I think at this point, what the U.S. is trying to do is secure some kind of a pause in the conflict, either with Hezbollah in Lebanon or with Hamas in Gaza before the U.S. election on November 4th. Whether they'll actually be successful, I mean, the last year tells us that the U.S. hasn't been particularly successful in really kind of calming these tensions, but we'll see if this effort actually does move the needle here.
Is there room? I mean, so far, Benjamin Netanyahu has not really given much of an ear to the pressure coming from the United States. And we don't know, on the other side, whether China is using or how it's using its influence in Tehran.
That's right. And yeah, I don't know. I mean, when you've only got a couple of weeks before the election, it may behoove Netanyahu to say, look, I want to wait to see what ultimately happens, because both, Kamala Harris and Donald Trump have suggested different ways in which they'd approach this conflict. If the idea is that you would reach a ceasefire, a significant ceasefire ahead of then, not sure whether that political uncertainty is going to play into things here. But at this point, I mean, if, the U.S. can accomplish even a pause in the fighting on these two fronts within the next couple of weeks, I think that would be something of an achievement here.
All right, Jill Desis, thanks so much. Bloomberg News desk editor Jill Desis. Dave?
Yeah, I guess on that note here, let's talk about some of the other stories we're tracking along these lines today. So China is on track to become the world's largest market for Russia's pipeline gas this year. That's as Europe cuts imports over the war against Ukraine. Now, Bloomberg calculations indicate that Russia's gas giant Gazprom exported 23 billion cubic meters of natural gas to China in the first 9 months of this year. That's a nearly 40% jump from a year back. Now, BHP has gone on trial in London over a devastating 2015 dam collapse at a Brazilian iron ore mine. Now, the company is accused of trying to avoid paying billions of dollars in compensation to those affected. Now, the London case will test at least how far English courts are willing to punish firms over environmental disasters that happened far away. More than 620,000 Brazilians are seeking around $47 billion. Right, back to markets right now. We're looking at FX markets, and this dollar strength continues. I'm looking at my screens. I need to scroll all the way down to really get a sense of when the dollar fell for 2 or 3 straight sessions, because the last month has really been about dollar strength. And in fact, so much so that when you look across this pocket of FX in the Asia-Pacific, Southeast Asia, Indonesia is needing to intervene. In fact, Bank of Indonesia just confirmed that they are intervening in the FX markets to smoothen out a lot of the vol that's out there right now. let me read it for you, in fact, if you don't believe me. The central bank is intervening in the spot domestic non-deliverable markets to smoothen all these gyrations in the rupiah as it fell on Tuesday. That's according to Eddie Susianto, who's the ED, of course, for monetary management. Of course, it's not uncommon, I think, just to underscore the point that while it doesn't happen every day, it's not uncommon for Bank Indonesia to do this. Given the move so far and really looking at your screens, the rupiah is the biggest decline or biggest weakness across the Asian FX space against the U.S. dollar. Now, in case you missed it, and well, you flipped the boards, we're looking at earnings. I'll also tell you about dollar yen, which touched the lowest since August 1 or July 31st. And if you remember back in early August, was a massive unwind of the carry. And guess what? We're back to those levels at 150. Speaking of, and just to pivot back to earnings here, 4.5% on ZTE. Out with earnings, and few and far between really as far as earnings go, but some of the big ones in insurers and of course out of the company here. Third quarter earnings missing estimates here. You have third quarter revenue coming in also below expectations here. It seems, based on commentary, according to Citigroup, that the domestic carrier network business really weighed on earnings amid declining capex from some of the telco operators. And speaking of telco operators, Unicom and China Telecom are set to report earnings today and get guidance, I guess, on what capex might look like as well. Global macro movers for you as we go into the Japanese lunch break. Plenty more ahead here on The China Show.
And welcome back to the China Show here on Bloomberg. We are getting some lines out of the State Administration of Foreign Exchange, or SAFE, briefing in Beijing. As you can see here, a number of different officials, foreign exchange officials in Beijing, talking to the media. Essentially, as we've been talking about, a stronger dollar of late, and the renminbi now weakening a little bit onshore at 7.1234. Offshore also weakening, albeit slightly. We're getting a headline just basically saying China to stabilize the FX markets at appropriate times. No specifics, though. Essentially, that they will. I'm not saying, Dave, that they're going to intervene or anything like that, but they're going to stabilize the FX market at appropriate times. We'll be marking this press conference in Beijing as the lines come across the Bloomberg terminal.
Yeah, I guess to borrow a phrase from both Michael Jackson and Mariah Carey, to put that together, we'll be there, right? If and when we are needed in this market. Be safe. There we go. We'll leave those lines there for now. Have a look at Japanese markets, and pardon the banter right now. We're looking at the Japanese lunch, and you know why? Because there's really not much happening across these markets. So Steve and I...
That's a better song. Nothing ever happens.
Nothing ever happens
at all.
Is it a Guns N' Roses song?
No, it's Delamitri.
Okay. Check out the gap there. 1.5% to the downside on the Nikkei 225. Dollar yen, if you're wondering why we're back at 150.70, I wouldn't say blame the Fed. Maybe blame the markets for running a little bit too far ahead of that Fed conversation right now. So the dollar has been stronger for almost every day over the last 3.5 weeks. The Asia dollar index is going the opposite way. Hence, we're trading at 150.76 here against the dollar yen, which actually takes you all the way back to August 1st or July 31st, which is when that sort of cross-asset, global-wide tremor of that carry trade unwind took place. We're back at these levels right now. The sell-off across the bond space continuing in the 10-year yield over in Japan, as you can see here, closing in on that 1% handle. Asia, ex-Japan, looking at this, across sector groups, every single sector with the exception of, well, classic textbook, flight to safety or caution. Utilities are up, every single sector is down. S&P futures are down about 0.1%, and Asia, of course, is off by about 0.8% of 1%. Right, now the story really here is while we wait for, well, several things, right? You have the Fed and where they actually land on the neutral rate. In about, how many days to the U.S. election? 2.5 weeks, almost?
Yeah.
The U.S. election? Well, we wait for what happens there. You talked about this earlier on, where investors are in limbo, right? Because we're also waiting for a big number out of China, and...
Well, they're in limbo as far as, one-way bet. I mean, when stimulus was coming out of China at the end of September, it was sort of a one-way bet right then, right? And also when the Fed obviously cut 50 basis points. At the time, it seems like, well, we're now pivoting.
Yeah.
But now the chorus is coming from a number of different Fed officials that maybe a little bit more caution is necessary. So it leaves a big question open at the November Fed meeting.
Yeah, and those two things put together, I think, in the China conversation, right? This reset in markets and valuations. We were having this conversation earlier on with our guest out of Beijing, Xiaolin Chen, KraneShares. They run, of course, a bunch of products and ETFs in the U.S. I think KWeb is one of them, one of the more popular ones as well. So she thinks on the China conversation now is a good entry point to those levels. And the question markets have is, they've been pouring a lot of money over the years into at least some of those products, and it's really gone the opposite way, because in terms of the wealth destruction, I think we have a Bloomberg story which highlighted this a few days ago. I think the graphic's about to come up on your screens. Is it? Do we have it ready? Yes, it's ready. So I think Cathie Wood, KWeb is one of the, can I just use it, culprits, quote unquote. Was it a value trap? Is it simply a cyclical trade within a structural downturn, or have things changed in China, right? So I think you can read about this separately. This came out a few days ago. We spoke with Xiaolin Chen, I was going there, and she had this to say about where we are in this Chinese market.
We did witness quite a massive inflow to China-related ETFs overall in the market. We have experienced quite a few billion inflows into our own ETF, probably the largest ETF in the market that has the most inflows from investors globally into China ETFs. Obviously, now we are seeing some pullbacks in the market in terms of performance, but we really sincerely think this is important steps to be materially for this market to change fundamentally in terms of looking at this China as an asset class.
And we had the perfect guest to talk us through the ETF space. Joining us here on set in Hong Kong, Travis Spence, Global Head of ETFs at JPMorgan Asset Management. It's nice to see you in person, and welcome to the show. Thanks for gracing us and giving us your time today.
It's great to be back here in Hong Kong, and great to be talking with both of you. Thanks, David and Stephen.
What's keeping you guys busy in the region?
Quite a lot. So we were just talking about China.
Yeah.
We're really interested in the China ETF market. In fact, we're the only global player that has a local Chinese ETF business in China. And this year, we've been very well aligned to the Chinese regulators trying to boost up the CSI A50 and A500 indices. So we participated in both. We launched ETFs in both of those. Really strong IPOs, and then it's continued afterwards. So we're really encouraged by the demand that we're seeing locally in China. It's going to be a market that we continue to focus on across the region.
Are you seeing the institutionals looking at ETFs as a bit of a change in strategy towards China rather than individual stock pickers? Because, again, the policy has been targeted more towards new industries, but not necessarily. It's been at the expense of certain bigger names that we've already known globally.
Yeah, I think just take a look at some of the flows that we've seen just in the last month. So on the back of the stimulus you mentioned from September onwards, we saw in the U.S., and it's been really a U.S. ETF phenomenon, about $15 billion that came into Chinese equities through the U.S. ETF market. That was just over that last month. Prior to that, there was about $6 billion outflows from the ETF industry in Chinese equities. So a big reversal. I think a big boost of trying to get into the market early in that stage. But we would say China is very much a bottoms-up stock picking market. We want to be very active in that market. That's what we do in our strategies there.
Right. Just before we pivot to Asia, do you have anything more in the pipeline in mainland China that we might and can expect over the next couple of months? Give us a teaser of what's to come.
I would just say watch this space. China's a really exciting market. And again, we've got a great position in that space. We're going to continue to think about China in addition to the other countries around the region. So, we've had a strategy since we launched our ETF business about 10 years ago now, and we've just crossed $200 billion. But really two strategies that we've had. The first is taking the best of what we do in our active management. We're a $3.5 trillion asset manager, and so we have the same portfolio teams, the same research analysts, the same investment strategies, in some cases that go back 30-plus years, and we've been bringing those into the ETF wrapper across the globe. The second part has been innovation. So taking some of the great investment strategies that we have, packaging them into interesting solutions that clients can access through the ETF. So Best example is our equity premium income strategy. So we launched that in an ETF about 5 years ago in the U.S., and that gives an enhanced yield on the S&P of 7 to 9%. You put that on a NASDAQ index, and that's 9 to 11%. So really attractive from an income standpoint, but still being invested in the equity side. That suite now is available in the U.S. We launched a global version in UCITS, and so what we're trying to do for Asian investors is take some of these great strategies that we've been developing, make them available. So list them locally, have feeders that are available locally, and then in some of the local markets start to issue local ETFs. So China's a great example.
Right.
Australia, we've launched domestic ETFs in as well. Between the two, we've got about 16 ETFs in the region. And then Taiwan, I think, is an interesting market going forward.
That's what I wanted to ask you about, because, again, there's a transparency issue in China that has spooked a lot of global investors over the last couple of years. Is Taiwan a bit of a proxy, obviously, for semiconductors and chips and the ETFs? A lot of money has been pouring into ETFs in Taiwan. But not only as a chip proxy, but as kind of a China stimulus proxy as well.
I think it's that, but I think the local market in Taiwan, which has been seeing all the growth in the ETF space, is one of, they want to access global strategies, but domestically based in Taiwan. So I think that's where we're going to see more innovation going forward. We expect to see an approval for active management in ETFs in Taiwan, hopefully by the end of the year. And that will pave the way for us being able to think about bringing more of our global strategies to the Taiwanese investors. And I think that's going to be a really interesting space to watch.
Yeah, I know you're excited to talk about active strategies, but I guess before I get to that, you mentioned $200 billion. You're just above that in AUM. 120 products, if I'm not mistaken. 118 ETFs? Yep. Well, first, I guess the question is $1 trillion AUM the North Star? What's the path from 200 billion to 1 trillion? Do you have a rough timetable?
Yeah, well, look, I think so we look at the overall ETF industry and the flows, and what we're seeing is really a change in investor preferences towards ETFs and the ETF vehicle, but also towards active management. So this year we're going to hit we're already crossing over 1.2 trillion in net flows. We think that with that kind of momentum in the ETF industry, it's currently about 14 trillion. We think it gets to about 30 trillion by 2030.
Okay.
Then you look at inside the ETF industry, the biggest change has been in active ETFs. So active ETFs have now grown. We just crossed over $1 trillion in total assets, but that industry didn't exist 10 years ago. And that 1 trillion is about 7% of the industry. But this year it's taken in 20% of net flows into the ETF industry. And in the US, it's even been higher at about 30 trillion. So we think that active is going to continue to grow. We think by 2030, if you extrapolate that out, growing at double the rate of the ETF industry, we get from 1 trillion to 6 trillion. I think that sets us up in terms of us being primarily an active manager to be able to manage around 1 trillion in that time frame as well. So we're pretty excited about that.
And how confident are you that this pickup in active is a structural trend? That's one part. And the other part is, what are the specific product gaps in the Asia Pacific that you would like to take advantage of, if that is in fact a structural move?
We absolutely think it's structural. And I think over the last few years, we've seen a lot of demand in the active ETF space for things like the derivative income, the equity derivative income space that I talked about before. We've been a leader in that space. Things like ultra-short income or ultra-short fixed income as well. This year, we've seen a shift more into the traditional core asset classes. So large cap equity in both U.S. and global, more intermediate bonds and core plus bonds. We think the fixed income market for ETFs, especially on the active side, is also going to be a major driver of growth. But that shift into more core asset classes is where we see the trend going forward. And that bodes really well. We're a very traditional asset manager. And so managing those kind of core asset classes, taking the best of our traditional capabilities and putting those into the ETF wrapper, we see that as a major area for growth. And again, fixed income is going to be quite exciting going forward.
Travis, thanks so much for joining us here in Hong Kong.
Thank you. Nice to be here.
Travis Spence, Global Head of ETFs at JPMorgan Asset Management. And still ahead, we'll discuss today's trading debut for Hyundai Motor India after raising $3.3 billion in the country's biggest ever IPO. This is Bloomberg. And welcome back to the China Show. The Indy Nifty 50 futures there. It's straight. It's flat. Looking for a flat open. As we are going to have India's biggest IPO ever is on the cards. Obviously, that is the Indian unit of Hyundai Motor making its trading debut in the next hour. The $3.3 billion listing is set to be India's biggest IPO ever. Bloomberg Intelligence analyst Shuli Chen joins us now. How is Hyundai Motors India valued against its local peers, and what are the prognosticators saying about its prospects?
Yeah, so we all saw that India stock market had a great run over the past few years, and with the growth optimism about the country's economies and also businesses, the companies there definitely enjoy higher valuations versus their global peers, and that's basically a similar story for Hyundai Motor India. So look at the IPO price. Our calculation shows that it implies about more than 20 times its forward fiscal 2025 earnings ending March. That's basically very close to the valuation multiples of other Indian automakers like Maruti Suzuki, Tata Motors, and Mahindra. But if you look at the parent, the South Korean-based Hyundai Motor Company, it trades at only 4.3 times forward earnings. So if you compare 20 versus 4.3, that's a huge Indian premium we're talking about, right?
Yeah. And the interesting is they picked a market where they could offer demanded premium, but then they're taking the proceeds and giving it back to the parent, if I'm not mistaken. So what's in it for investors here?
Completely right. So all of the proceeds will go to the South Korean parent Hyundai Motor Company. We're still waiting for management's official comments on how are they going to use the proceeds, which will be a large focus because Hyundai's third quarter earnings call is coming up later this week. We'll hear more on that. But back in August at Hyundai's 2024 CEO Investor Day, at that time, the company put a lot of emphasis on its plan to boost shareholder returns, including dividends and buybacks, and also to increase investments, especially in electrification, autonomous driving, to secure a long-term competitiveness in the auto industry. So we think the $3 billion in proceeds could also go into that direction, and definitely the cash boost gives Hyundai Motor Company, the parent's investors, greater visibility on the company's abilities to deliver on those long-term strategies.
Well, how important is the India business to Hyundai? You can see this chart here, 19%. That's coming from sales by plant that are located in India. So it's a sizable chunk. So what's the future growth plan here? You mentioned electrification. We know Hyundai and the Ioniq brands and other electric cars is a big priority for the South Korean company.
So India is actually the largest manufacturing base for Hyundai outside its home South Korean market. And you see the sales contribution or production, production contribution is almost 20%. So there are two reasons that Hyundai definitely wants to grow its India business. First, it's a rather large local market, 4 million passenger cars sold in India last year, but you can see the auto penetration is still low, so there is more room to grow. And the second thing is it's emerging as a low-cost manufacturing hub, and it's a great substitute of China, where some global companies are trying to balance their risk of over-dependence on China manufacturing and supply chains. So that's a huge bonus for the Hyundai company to grow their India business.
Yeah, the China plus one strategy. Joanna, thank you so much, Joanna Chen, our Bloomberg Intelligence analyst. And of course, this is a massive day coming through, and we'll see what the initial trading is going to be like in about 40 odd minutes from now. You can turn to your Bloomberg terminal for more context on this, of course. So 3.3 billion IPO, second largest car maker in India by sales, biggest ever in the South Asian nation in terms of the listing here. So stay tuned for this. I think Steve wants to say something.
I didn't know that their biggest production base, or second biggest, is in India. And if you have 19% there in India, and you have a low cost base, you can scale easier across India.
That's a big market for them.
Yeah.
We'll see what investors think and feel about this in the trading debut today. This is Bloomberg. You're watching The China Show. Time for Trending in China, which is a look at what's making headlines in national newspapers. We'll start things off at the Fujian Daily. It's reporting on live-fire military exercises today on the Chinese island of Pingtan, which is just off the Fujian coast. The paper doesn't give any more details, though, but Pingtan Island lies directly across from Taiwan. Now, Beijing has conducted a series of major drills around the island after Taiwanese President Lai Ching-te's speech this month, when he said that neither side of the strait is subordinate to the other.
Well, Dave, also trending in China, most outlets are focused on the BRICS summit set to begin in the Russian city of Kazan. The People's Daily says China is poised to guide the bloc to play a bigger global role. And the Global Times posting this editorial calling the expanded group, BRICS that is, an express train of development for the Global South. They see greater BRICS as carrying more global weight and representing the advantages of emerging markets. The editorial says BRICS also allows for the Global South a chance of catching up with the West in terms of economic development. And the social media platform Xiaohongshu has been growing its domestic and international following, defying China's tech slump. And Bloomberg Opinion columnist Catherine Thorbecke thinks a Hong Kong IPO might be next. Do we have Catherine here, Dave?
Well, we'll find out on live TV. Catherine, are you there? No, not yet. Okay.
Yes, I'm here. Can you guys hear me?
Warmed up. Oh, there we go.
There we go.
Nice to hear from you. Well, yeah, I mean, tell us a little bit about this, your column, and how it's defying the tech sector downturn we've seen so far, and hopefully that turns, obviously. But what is driving its success?
Right. So Xiaohongshu has quickly become the fastest growing app in mainland China. And it's really been sort of weathering this tech downturn. We've been seeing a lot of pain in the domestic Chinese social media market ever since sort of the government crackdown. But this app has just really been sort of growing very fast. It has more than 300 million monthly active users. And I think part of the reason it's been so successful is because it's sort of been driving sort of Gen Z trends in China. And some of those are sort of bargain hunting and, comparison shopping and sort of finding ways to save money. And so it's found a way to really sort of build an authentic community, even during this sort of consumer pullback and sort of macroeconomic uncertainty.
Okay, and so why do you say policymakers, global investors should be, I guess, paying more attention to this app in particular? What are the non-obvious reasons?
So I think, like I mentioned, this app really sort of has its finger on the pulse of China's Gen Z, which I think is a really sort of misunderstood demographic. And if you look at, how Chinese policymakers are trying to boost consumption, and then you look at sort of what the biggest trends are, which is sort of staying home to work out and, finding sort of going bargain hunting, you might see that some of those policies are sort of falling flat. And I also think global investors should really be paying attention to this app right now because the government has sort of signaled that the tech crackdown is over, but at the same time, we're still sort of waiting to see, a broader comeback. And so if this app can successfully IPO, if it can sort of go public, I think that will be a sort of a signal going forward for the Chinese economy.
Catherine, thank you so much. Catherine Thorbecke there, our Bloomberg Opinion columnist. Check out her column, of course, there on Xiaohongshu.
Little Red Book.
Little Red Book. Yeah.
Mao Zedong reference, but generally for Gen Z.
Yeah. The East is red. That applies to markets, too, when you look at really where prices are right now across these equity markets, coming out of Europe. Okay, get my historical reference there. Into the U.S. and into the Asia-Pacific. One bright spot, though, is really in EVs. And this note out of Citi actually boosting this. I think overnight you did see a pop there, pop here, across some of the listings here in the Asia-Pacific. As far as earnings go, China Telco, China Unicom, and United Network are coming out with earnings later today. All right, that's it from us here on The China Show.